Well, good afternoon, everyone, and welcome to our weekly webinar where we'll talk about what we see happening in the global economy, in financial markets, and the world of wealth management, and of course how all this impacts our decisions on the best courses of action for our investment strategy. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined on the call by my partner and colleague, Paul Tepsich, the founder of HighRock, and our financial planner, Bianca Tomlinson, is also with us. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask questions. Remember, if you have a question, it's likely that other listeners may have the same question, so we encourage you to engage us. Based on some excellent feedback from our listeners, we have made some adjustments to the format of our weekly call. If you are a first-time listener and would like a little more information about our private client services and our philosophy of transparency, we have a separate webinar that will provide you with this on our website adjacent to this weekly webinar. Well, once again, financial markets were shut out of the top Google searches for the week last week as the Toronto Blue Jays, and good for them, Major League Baseball playoffs, Travis Brown, I have no idea who he is, Randy Quaid, and Justin Bieber were all at the top of the lists last week. Now, apparently, my trip to the U.S. Federal Reserve in Washington did not make the list. You may note all the tourists lined up for a glimpse of one of the most powerful institutions in the world. However, just down the road, there were lots of folks at the Million Man March, and that was quite an event in Washington. And plenty of economists and central bankers at the National Association for Business Economics annual meeting were in town, which this is a meeting and an association which explores the tectonic forces shaping the world economy, what is happening in demographic shifts, the political changes, technological advances, deeper trade linkages, and environmental stress. These are all pressing businesses to rapidly evolve and stressing governments. It's all in the context of a subpar recovery from the Great Recession. And so there was a great deal of bright minds gathered together in Washington, including this gentleman, our own Bank of Canada governor and fellow University of Western Ontario alumnus, Stephen Poloz. His key message basically being that old-style inflation targeting of monetary policy is no longer as influential as it once was, and that, and I quote, for central bankers as we work to understand and react to the aftermath of the global financial crisis, the key question is how we should integrate financial stability concerns into the conduct of monetary policy. He also said that there is some urgency to this issue given the way the crisis highlighted how much we have yet to learn about the linkages between the financial system and the real economy. Now, given this level of uncertainty, it is difficult to put a great deal of faith in the projections and expectations of an improving economy that's being touted by Mr. Poloz and his fellow central bankers at the Federal Reserve, and who are now trying to differentiate expectations from what is actually happening. Of course, we want their positive sentiment to turn into a better global economy, but Paul and I are not paid to hope. Our job is to understand the risks and protect our clients from those risks. The more we listen to economists and central bankers who have been overly optimistic, the more we get to understand that there are greater risks in the system that are now overtaking the optimism. Last week we talked about the latest U.S. economic data, including the lower than expected employment growth. There's not been a significant amount of data released since. There are some key indicators to release later this week, including producer and consumer prices, retail sales, and industrial production. And this will give us some insight into inflation in September and what the consumers and producers have been up to as well. As U.S. Federal Reserve Vice Chairman Stanley Fischer stated to the Group of 30 International Banking Seminar in Lima, Peru this weekend, both the timing of the first rate increase and any subsequent adjustments to their federal funds rate target will depend critically on future developments in the economy. However, in a speech today at the National Association of Business Economics, Fed St. Louis President James Bullard suggested that normalization should actually begin now. So there's certainly some disagreement at the Fed as to what the timing should be. So how did financial markets react last week? With little new news to trade on, volatility has continued to stabilize somewhat. Not much movement in the U.S. 10-year bond. Equity markets went pretty much sideways after a big bounce higher the week before. Now we think that there will be a test of the downtrend that began back in May at the 2020 to 2040 level on the S&P 500, and that is what will give us some understanding of what the short-term market sentiment will be. Currently, the markets are focused on very short-term factors, and earnings announcements will likely dominate the news wires and determine whether or not traders are prepared to buy or sell. On that note, I want to remind all of our listeners that we at HIROC are cognizant of the short-term trends, but we also have to be guided by the medium and long-term fundamentals. Now, at the moment, our medium and long-term outlooks remain highly uncertain, and it is our wish to continue to be more worried about protecting our capital than to be worried about growing it at this particular point in time. Well, in Canada, last Friday, we had the latest data from Stats Canada on the labour force. Employment was little changed for the fourth consecutive month. In September, there was an increase of 12,000, or just 0.1%. The employment rate increased by 0.1 percentage points to 7.1. I meant to say unemployment rate, as more people participated in the labor market. Part-time employment rose by 74,000 in September, which was largely offset by the decline of 62,000 full-time employees. Now, on a longer-term trend basis, there were gains of 63,000, or 0.4% in the first quarter, followed by 33,000, or 0.2 in the second quarter, and employment grew by 31,000 in the third quarter of 2015. So the 12 months to September of this year, employment increased by 161,000, or just a little under 1%. With all the games in full-time, with all the games coming in full-time work, over the same period, the total number of hours worked rose as well. From a provincial perspective, because we do have a broadly diverse country, employment rose in BC, Alberta, Manitoba, Nova Scotia, Saskatchewan, and PEI. It fell in Ontario, Newfoundland, and Labrador. And the Canadian dollar continued to gradually improve over the course of the week, although we did see commodity prices slip just a little bit. Nonetheless, the TS jumped a little higher, but still within the downtrend which began back in April. Around the global economy, some of the latest data show that inflation in the UK actually slipped below the zero mark in September, but the core rate remained at 1%. Also, China today announced significantly lower than expected imports, which is definitely taken as a negative for the global economy, and certainly there was some concern about China's domestic economy as it continues to struggle. So what do we see coming? Well, we tend to look at bond markets to continue to tell us that obviously inflation expectations remain low because the prospects for economic growth continue to be low. Let's compare, as we did last week, various country yield curves. The time to maturity is on the horizontal axis here on this chart, the yield on the vertical axis. You can see the U.S. 10-year government yields are just a little over 2%, while the U.S. short-term yields out to about 6 months are at zero. Basically, this is telling us that the likelihood of seeing a Fed rate hike is not priced into short-term bond markets, at least for the remainder of 2015. And that is interesting. German bond yields, as they continue to be out to 5 years, remain below zero. Again, concerns of deflation being the key factor in the European economy. As far as our high yield bond indicator, which we watch on a weekly basis and which has historically been a leading indicator for where equity markets tend to go, it moved up a little this week, but at this point it's not offering us much direction in the short term. But clearly over the medium term it is still trending down, and this definitely adds to our caution. Well, in case you haven't guessed, we still think equity markets are expensive, and the rally 1.5 weeks ago made them more expensive. The 10-year average price to earnings ratio currently at 14.1. Comparatively, the forward 12-month average is now up to 15.9 versus what we reported last week at 15.1. So stock prices did get a little bit more expensive. Again, as a guide, last May, it peaked at 17. So the equity market rally was responsible for a higher reading, but we are at the beginning of the third quarter earnings announcement season. Expectations are for earnings in aggregate to have declined by about 5.5% for the third quarter. We shall follow the progress of these earnings over the course of the next few weeks, but if they do in fact come in negative territory, as I said last week, it's going to be the first back-to-back negative earnings quarter since 2009. Again, some reason for caution. Interestingly, earnings for the fourth quarter now have been revised lower to show slightly negative growth as well. So from revised down from being positive to slightly negative. So expected earnings do not appear to be being revised to the upside. So for us, that is just cementing the fact that the fundamentals are not aligning with the current trading patterns. And the other metric that we like to look at, enterprise value to earnings. The S&P 500 companies are valued at current market prices 12 times, which is up from last week at 11.75. The 10-year average is about 10.5. But as Paul mentioned last week, in our tactical growth model, we're not much interested in anything that is valued at over 8.5 times. So again, continued caution. Well, last week we pointed out the relevance of margin debt as another leading indicator of equity price movement. Investors who borrow or use leverage to buy equities are okay until they start to see the value of the collateral decline. When asset prices drop, lenders either want more margin or they want the borrowers to pay down their debt, which means that the borrowers need to raise cash. They do this by selling assets, and in some cases they are the most profitable assets, and in some cases the most liquid assets. But this selling does definitely increase volatility and uncertainty. Now, we haven't seen much of that kind of selling over the course of the last week. In fact, we've seen more buying, but we haven't really seen the updated margin numbers, so we'll be watching that quite closely. Okay, well, we've talked about this a lot, but from the highs in May to the lows in August, the S&P 500 dropped about 12.5%. At current levels, it is down about 6% from the highs. So that bounced back up into the 2,000 area. And what we think is a short-term situation. Fundamentally, prices have been getting a little bit cheaper, but we still think they're expensive by historical standards. And as we've often said, it wouldn't surprise us to see a decline of something for up to 20% from the high. So a little bit further to go before it makes us comfortable to do any buying of equity assets. And I talk about this every week, but we do continue to have a long-term perspective because we believe markets are cyclical. It's never clear where we are at any given time because there's a lot of activity going on, and it definitely can make adjustments. We have to make adjustments as we determine the current market psychology. We're looking to the buying opportunities, but we wait until they present themselves to us. And all of the discussion today definitely outlines our ongoing, and my apologies for the repetition, but our view that with continued low economic growth, low earnings, low commodity prices, low inflation, and low interest rates, there's not a lot of hope for getting decent returns or above average returns for investor portfolios. And we need to continue to make sure that expectation is managed across our client base. Of course, when we do change our perspective, you will see activity in your portfolio, and you'll certainly hear it from us on this call. Well, as always, our focus is on getting good risk-adjusted returns, and that means we don't want to be driven to chasing higher returns at the expense of adding risk to client portfolios. At High Rock, we use 3 investment models, and I talk about these every week, but we have government bonds, we have corporate investment grade bonds, high-yield bonds, and we do want to own from time to time fixed-rate perpetual preferred shares. There has been a fair bit of issuance in the preferred share market recently, which has been driving the price of the index considerably lower over the course of the year. We do believe at some point there will be some opportunity, but at this point in time, as long as we see this issuance driving prices, we'll stand back and be patient as well. We do expect that at some point in time, as we head into the end of the year, there will be some tax loss selling so that investors can take advantage of any capital gains that they need to offset. Within our global equity model, our objective is broad diversity across many different geographical locations and economic sectors. Remember that we buy companies and not countries, so we use exchange-traded funds to do that, and we invest in, and the percentage weights could change at any time. We also seek to find the lowest cost ETFs as is possible. We also own some of these ETFs in US dollars or have cash available for when we need to make our purchases. Paul tells me there's not much happening in the Canadian tactical growth equity model at this particular point in time, usually made up of Canadian small and mid-sized companies that we believe through our in-depth research that have an outstanding growth potential. We will tell you that we can hold up to 10 names and may in fact hold some US companies here, but at the moment we only own 3 companies in this model, and again that just is a reflection of our current level of conservatism. Well, I talk about this every week, or have been for the last few, but just to quickly go through it. A client portfolio, depending on their goals, objectives, risk tolerance, and their wealth forecast, may strategically comprise all of some of these models in varying degrees. Don't forget, Paul and I own the same models in different mixes. My 60% equity and 40% fixed income balance has 40% of the fixed income model, 50% of the global equity model, and 10% of the Canadian growth model. Paul's portfolio is skewed to more growth equity, but also has more fixed income to provide him with some balance. As well, a more conservative balance could perceivably have 60% or even 70% fixed income. Remember that these are target allocations. As cash flows into a portfolio, or if it flows out for cash flow needs, it requires portfolio rebalancing. This means that we need to apply our disciplined approach to buying and selling constantly. It also means that at any given time, our portfolios may not be fully invested, but we are always working to achieve the target weightings at the appropriate prices. I say this every week too, but once again, our research gives us the groundwork that we thoroughly believe a balanced portfolio will give investor better risk-adjusted returns than some of the owning outright equity indexes like the S&P 500 or the TSX. Okay, let's talk about performance. As I said earlier, not a lot to show in the equity model. The U.S. equity market, the S&P 500 was actually up about 1% at the close. I noticed it was down a little bit more than when I put these numbers up, but year to date it's about off about 2%. In the Canadian portfolio, the TSX is up about 1.5% this week, but down about 4.5% on the year so far. Euro area companies, the Euro stocks is unchanged this week, up about 3.2% so far this year. The Japanese companies, the Nikkei 225, up by about 2.5% this week, but up about 5.5% so far this year. UK companies are unchanged on the week. The FTSE 100 is unchanged on the week and down about 2.7% this year. We also own a small weighting of Australian companies and the All Ordinaries Index unchanged this week, down about 2.25% on the year. So not a lot of movement this week, but certainly over the course of the year, we've seen a fair bit of activity. Certainly, we saw a lot of volatility in August and September. Paul and I believe that may not necessarily be out of the way as we head into the end of the year. So again, our desire is to be a little bit more cautious and be more protective of our and our clients' capital. And China, well, China's market was closed the last time we talked for a week. So since September 30, actually bouncing up about 8%, but on the year-to-date up about 1.5%. And the ETF that we buy for our emerging markets model is, or buy in our model for emerging markets, is unchanged so far this year. So by comparison, and I talked a little bit about my portfolio before, but my portfolio is up just about 2% so far this year. So there's that balance working for us, even though most equity markets, certainly North American and European, North American and UK markets are down slightly. We've got a positive balance, positive growth in this model, or in this set of models. Okay, that's it for today's discussion, and if anyone is there that might have a question, please feel free to ask it now. Well, Paul, it looks like we overwhelmed everybody this week, so let's say that that's it for today's discussion. Of course, if anyone has questions and they're listening to the recorded version, we are more than happy for you to send us an email or pick up the phone and give us a call. We'd love to get feedback on these webinars, and it really does help us determine how we're going to present some of this data. And of course, we want to make sure that you folks are listening, are getting out of it what you'd like to get. So that's it for another week. Thank you for taking the time to tune in. I hope you have a great rest of the week, have a great weekend, and let's go Blue Jays. How exciting is that? If you're watching, I highly recommend pretty exciting stuff. Anyway, it's Scott Tomlinson signing off.